Trump is making headlines again. This time, he's not just criticizing Federal Reserve Chair Jerome Powell. He's reportedly threatened to fire him. Consequently, U.S. financial markets have experienced another sharp, simultaneous decline across stocks, bonds, and the currency, with stock, bond, and foreign exchange markets all falling sharply. Just how risky are Trump's actions? Why is the Federal Reserve's independence considered so vital? And if that independence erodes, what shockwaves could it send through the global economy? Since taking office, Trump has cultivated a reputation for controversial actions. From suggesting bold ideas like acquiring Canada or Greenland to implementing aggressive policies domestically and internationally, like initiating trade wars and lambasting the Federal Reserve, he hasn't shied away from confrontation. He even publicly mused about dismissing the current Fed chair, Powell. More recently, he again pressured Powell via social media, demanding immediate interest rate cuts and complaining the Fed's actions are always too late, citing Europe's multiple rate cuts as an example. This instance marked one of several times Trump publicly challenged the Fed within a short time frame. Following such remarks, U.S. financial markets witnessed a rare simultaneous sell-off. The stock market plunged, the U.S. dollar index dipped below 98, and bond yields edged higher. Such synchronized downturns are unusual because stocks and bonds typically move inversely. When both fall together, it often signals a potential liquidity crunch, where a shortage of available funds compels investors to sell assets across the board. Why is Trump so focused on Powell? Democratic Senator Elizabeth Warren, among others, has argued that Trump's rhetoric seriously threatens the Federal Reserve's independence. As one of the world's most independent central banks, the Fed's monetary policy faces minimal direct government interference. This operational independence is widely seen as a crucial factor underpinning the U.S. dollar's global dominance. If a central bank were entirely under government control, the temptation to misuse money printing powers could undermine the currency's credibility. For instance, if the U.S. government could dictate money creation without constraint, international trust in the dollar could erode. The Federal Reserve structure itself is designed to foster independence, consisting of the Board of Governors and 12 regional reserve banks. This setup aims to prevent unilateral government control and insulate monetary policy from purely political or private financial interests. However, the Fed's power isn't absolute. Its creation of money is typically tied to acquiring assets, and its net income is remitted to the U.S. Treasury. Still, the Fed can incur operational losses based on its policy actions, reporting losses of $114.5 billion in 2023 and $77.6 billion in 2024. Trump's challenges to the Fed have generated market unease because they touch upon the principle of central bank independence, considered a bedrock of the U.S. dollar's strength. Notably, any perceived weakening of the dollar's global standing could potentially boost the prospects of other major currencies, like the euro and the renminbi. In recent years, China has actively promoted the use of the renminbi for settling its international trade, achieving noticeable results. Reports indicated that in 2024, the RMB's share in China's own cross-border transactions surpassed the US dollar's share, reaching 51.24%. Furthermore, in the first quarter of 2025, the renminbi ranked as the fourth most active currency globally for payments, and the third most used currency in trade finance. This suggests that if Fed independence were perceived to be weakening, potentially diminishing the dollar's influence, the international use of the renminbi could grow more rapidly. Looking ahead, this could mean less reliance on the U.S. dollar for international commodity purchases like oil and reduced concern among renminbi holders about potential U.S. debt devaluation or asset freezes. What are your thoughts? Should the Federal Reserve maintain its independence, or should it be more aligned with the U.S. President's directives? If the Fed's independence diminishes, could the U.S. dollar's dominant global role genuinely be challenged? And what practical effects might the accelerated internationalization of the renminbi have on people's lives, particularly in countries increasingly using it? Share your perspectives in the comments section below.